Hello fellows, welcome to my channel. This channel is created for educational purposes only, dedicated to people who want to learn how to trade. Either you want to trade stocks, crypto, commodities or Forex. You will find high quality educational material. Either you are a beginner, advanced or an intermediate trader. For viewers that want to see more action and how we apply the theory in real trades, you can visit our live channel. Here we are trading our live account and applying the theory, proving that it can be done, while all trading profits go to our subs. However, as a beginner, I do not recommend starting with any real money. Trading is very risky and challenging. However, a risk comes always with a reward. You will find 50 videos to understand the theory, 12 sections. Each section is a playlist consisting of several videos. I do not recommend skipping chapters and trying to take classes from the beginning. We are using verified sources to provide the most accurate information. Remember, this is an educational channel and you will always trade with demos to avoid the risk. Make profits in the market is not the easy passive income you have in mind. The entire material is the same as you will find in most trading courses. The material is totally free and you don't have to pay any guru to learn generic information or waste thousands of dollars. So if you want to support us, subscribe, like and leave a comment for the YouTube algorithm. And you can post your progress in our Facebook page. Thank you very much and trade safe. In today's episode, we will see the fundamental analysis, maybe one of the most important tools you will need. This is another version of my original video that you can find in the description. I try to include all the important information from a beginner's point of view. I wish I could simplify a bit more the information, as fundamental analysis consists of several indicators and metrics. I will be glad to write us in the comments about the indexes you need further clarification. But what is fundamental analysis? While trading your entity, either a stock, commodities, Forex, analyzing and breaking down the impact of political, economic and social factors will give you an edge in your trading. Fundamental analysis will help you to get a more general view of the long-term economy's performance. Again, the principles are the same, but as the financial markets are considered to be the most complicated, this video is what you need. Keep watching us and you will adopt some powerful habits that will make you a better trader. Fundamental analysis is one of the three analyses that we are using in trading. Technical and sentiment have already been covered. Fundamental analysis is a set of social, economic and political factors, as we said earlier, that will and can affect financial markets in the long term. We have two major categories, quantitative and qualitative. There are some economic indicators related to the macroeconomy that will affect the currency exchange. Of course, we are talking about the long-term economic reports released related to the country's economic performance. It's up to you how you will be able to be informed about the news that is being released. So let's look at each and one of these indicators separately, as they are all important. There are several other indicators and indexes, but for the purposes of this video, we need to focus to the most important ones. One of the most important factors that will affect your trading in the long term is interest rates. And of course, Fed stands in the first position. The USD rate decisions is affecting all the currencies. The higher the interest rates, the more they are affecting the currency and the stronger the currency will become. This contradicts the main economical theory that states increased interest rates are a sign of a weak economy. But not all economies are the same, and you will understand what I mean. The decisions about interest rates is being taken in a cycle of 8 meetings in a year. In those meetings, Fed will decide the fate of the rates. They will increase, decrease, or remain the same. But why the USD is the most important? 87% of the daily currency that is being circulated, it's USD. So everyone will eventually follow them. Of course, there are some exceptions based on the currencies, based on external policy. I will give an example of the Bank of Japan and the JPY. They want an underrated currency because they want to get some benefits from their exports. Also, they are keeping rates low, as increased rates are a sign of a weak economy. The US on the opposite side has declared that there would be blood on the streets, if necessary. Central banks proceeding to major announcements that will be either dovish or hawkish. Hawkish is more aggressive, while dovish is a part of a more easygoing policy. A major factor is inflation, which affects the rates decision in the past years. The dogma here is a catastrophic mix. Even though inflation is being produced by government spending, when inflation is high, rates are being increased. This hurts the economy more than inflation itself. Interest rates decisions have a huge impact on financial markets, increase volatility, and we recommend not to trade while those big events are about to come out. Fundamentally, we know what causes inflation, and there is a link in the description. CPI is another indicator. The Consumer Price Index, CPI, measures the monthly change in prices paid by US consumers. Their willingness to spend creates higher demand, and eventually higher demand means higher prices, higher inflation, higher rates, and so on. Banks and money movers must make a decision. At this point, they want to make money more expensive. By making the money more expensive, drops the markets. Investors prefer the standard rates and the safety of the bank. I need to make a small reference here, as there are currencies that have been affected by commodity prices, such as the Australian and the Canadian, and some other examples that we will see in the currencies correlations episode. There is an inverse relationship between inflation and interest rates. The higher we increase rates, the lower readings we get in inflation. CPI comes to complete the information we are missing. It's an index and show us how the strength of the retailers has increased or decreased. An early CPI reading of increased activity will give higher inflation. That's why I've said to you, you need to have a strong analytical mind if you are willing to proceed into trading. I'm not judging technical analysis, but you will see some guys making some random lines in a chart. That's why we are making this series. And we are going into depth every time we are analyzing the markets. Higher consumer price index for a period doesn't mean a lot, and it won't affect the market. However, you have to pay attention in the long term. If you are having the data and you'll see that the indexes keep increasing, then we will have higher inflation, and you know what this means. To be more specific, the consumer price index consists of a set of indexes that measure price changes experienced by consumers. Specifically, the CPI measures the average change in price over time of a market basket of consumer goods and services. The market basket includes everything from food items to automobiles to rent. The survey includes almost 5,000 households in the United States. Participants are asked about the current and future market condition, economic condition, and work opportunities. But why this is important? Consumer confidence belongs to the group of economic indicators which measure the financial confidence among consumers. The more confident they are about the economic condition, the more confident they will be in spending money, which ultimately stimulates the economy. GDP is the gross domestic product, one of the primary microeconomics indicators used to assess the conditions of a country's economy. It represents the total monetary value of all goods and services produced over a specific period. This number is important as it represents the size of the economy. For example, when you see the GDP has increased by 3%, it means that the entire value of the economy has increased. Remember that this analysis is related to numbers, and you will also find some information related to each currency and not for every currency. In Europe, for example, not all GDP data are important, but if the Germany, for example, shows a higher GDP, this represents the entire Europe's economy and will affect the euro. Smaller countries of the Union with smaller economic activity will have no impact on the particular currency. Sales release. Data covers sales during the preceding month, which means that this is a timely indicator showing not only the performance of retail trade in a given country, but also price level activity as a whole. For example, in the United States, consumer expenditure contributes almost 2/3 to the national total GDP figure. The report usually contains two components, even though you will see them as total sales, which is the figure related to a percentage. The higher the figure means the economy consumes more. Durable goods is a broad-based monthly survey conducted by the US that measures current industrial activity, and even though the impact is not so high, it's good to have a basic knowledge. What is more important in an economy rather than unemployment? The most important figure is being published once per month, every Friday, the non-farm payrolls. It's a very smart way to define labor in the US. US data are the more important ones and can affect the market, creating high volatility upon release. The number shows how many new jobs were created that were not related to land or farm. Non-farm measures the quality of employment change. Non-farm are related to total employment activity. Other than unemployment, there are also employment rates. It's the same thing, but it gets more positive meaning. How many new people were employed. Too much info, I know. However, if you want to have an edge on your trading system, unfortunately, yes, you need to know too many information. A small reference to housing data. More home sales for a period means good news for the economy. Well, I'm sure many of you are aware of the housing bubble, but this cannot be analyzed in this episode. The important information here, if people are willing to buy new property and invest in new houses, overall it's a good sign for the economy. Two major categories, imports and exports, a simple financial scale of how many goods were imported and exported. This will be shown by a figure, either positive or negative, based on the amount of the total services and goods that each economy managed to import and export. Now it is important to know that each economy is different. We have some countries that are rich in minerals, so their economies are based on exports. The higher the value of their currency, the lower their exports will be. Some countries are importing goods from them. They need raw materials to work because they have some strong manufacturing fields. Very important when we are analyzing the balancing of trades. You need to pay attention if the country is an importer or an exporter. PMI index is a composite index comprised of 5 sub-indexes which usually correspond to surveys conducted on more than 400 purchasing managers operating within the country. They are chosen based on their geographic and industry diversification benefits. So we have sentiment analysis from the purchasing manager based on these 5 sub-indexes. There are 3 levels measured from 0 to 100, so the value of 100 shows for sure that the conditions were better. A value of 50, the conditions were the same, and below, the conditions are deteriorating. So what we are searching on this index is a reading above 50. This reading is showing that the sector is expanding in the case of manufacturing, which overall is considered a positive outcome for an economy. That's why the PMI index is considered an indicator that provides you also clues about the GDP levels. Factory orders are an economic indicator that consists of 2 separate indicators, durable and non-durable goods. You can maybe understand or you already know what I'm talking about. However, it makes sense. Non-durable goods includes items such as food, clothing, tobacco and other products. On the other side, durable goods refer to some design products that will last 3 or more years. You can imagine what that might be. Car, buses, machine parts, airplanes, everything that will last longer. This index is a bit underestimated because of course it's not so important. However, if you can decipher it properly and give it a look once in a while, it will help you with your long-term analysis. With an increasing trend of orders, we have a more confident economy. Pay close attention to the bank announcements. Banks are the policy makers, and especially the central banks. However, a central bank does not make a straightforward announcement. They don't want so much volatility in the market. That's why they need to pay attention when they are making some announcements and the way they will make the announcements. Remember hawkish and dovish. The leader again is the US. It is important to pay close attention when they are making those announcements. As the market will be volatile, try to avoid trading at those periods. Pay close attention to some major events, some war events, and some major incidents that might affect the market. This is the reason that the market is unpredictable. Keep an eye on your trading, especially when you want to analyze the markets. Again, some technical and some sentiment analysis won't help you with some random lines and some charts. For the news, we strongly suggest either using Forex Factory or MyFX Book. I don't have any benefits from them, however their platforms is much easier to use. I think that they are a bit sluggish, however it's still one of the best options. Here is an example of the economic calendar. You can drill down and check the information and the trend. How I use it is by choosing data with the highest impact. So all the important information will be there. Super important and take notes. Data has 2 sections. The first is what the data is expected to be, and finally the actual data. Now there is a small catch here. I will give an example of the most popular like non-farm payrolls. Let's check the values. As we said, we have 2 values. The data we expected and the data we finally have. So if the actual data are better than expected, it will be considered as a good sign for the USD. This can mislead you. The reason is very simple. The data might be worse than the previous month, and the month before. So we have a decline in the economy. In the end, it doesn't matter what the data are expected to be, but the actual data. And also compare them with previous month, or even better, with the previous year, same period. And we are not talking about the actual figures, but the actual percentages. Also, the unemployment is a more important factor. Many times you will see that you will have mixed data. For example, lower unemployment, but worst figures in non-farm payrolls. And that's how they release the data. All these small details and the combination of the data will make the difference. Not every single piece of information has an impact on the market. Timing some important news will help you. Try to make a small calendar with the most important information, like interest rates, unemployment, non-farm payrolls, and you will see a huge difference on the way you see the markets. That's it. Thank you for watching. Go back, repeat the chapters you are not sure, and trade safe. So that's it for now. Thank you for watching our videos. I hope you enjoy. You know that we need your subscriptions, likes, and comments for the YouTube algorithm. Help us to make more content, and trade safe.